we'll be talking about lease options, what they look like in practice, and the financials of them. And my goal with this is to uh, show you guys really an awesome exit strategy and um, a way that you can do seller finance deals and sub two deals in a way that's sustainable, meaning that you won't touch as much of your own money in the process. Uh, Lease options also work very well in markets that otherwise suck for long-term renting. So I'm thinking about places like New York and Southern California, where the market rents are so out of whack with the purchase prices for houses that it's almost impossible to find a cash flowing deal. Um, and so basically, the way a lease option works is that it's an exit strategy. So you acquire the house however you want to acquire it. It pairs nicely with seller finance and subject to, but you can lease option any kind of deal. So the way it works is you buy the house traditionally, however you want to buy the house. And then what you can do is find somebody who doesn't qualify to be a homeowner with a bank and put them in what's called a lease option. And so the way that works is that they'll give you something that's a little bit like a down payment. We don't call it a down payment. It's called the non-refundable option fee. And then they have a lease with you, but they're also considering themselves to be the homeowner. And so they're making payments not based on what market rent is, at least not usually. They're making payments based on what a mortgage would be. And what's cool about that is that there's always going to be arbitrage between how much you're buying the house for and how much you're lease optioning it for. Um, so I'm gonna get into I'm gonna do some screen sharing here to help illustrate this, and I will be asking for your participation at various points. Can you see my screen okay?
Yep.
Okay, awesome. Thanks, Brent. So I have the start of a chart here. And so what we have here is we've got two boxes, the acquisition strategy and the lease option exit. So let's go through a regular owner finance situation. What are the pieces that we're offering somebody when we do a, like a seller finance deal? Just kind of someone rattle them off. What kinds of things are we offering the seller?
Steady interest payments monthly.
Steady monthly payments.
Yeah.
Okay. Anything else?
Down payment?
Down payment. That's right. Down payment. Anything else that's relevant to the way that we're structuring these deals?
Um, I guess I don't know if it's always going to be in each deal, but interest. I don't know if that's something you gotta put down.
Yeah, we'll throw it in here. Interest rate. Um, all right. Anything else?
Balloon.
Balloon. Very good. All right. So we've got monthly payments, down payment, the interest rate, and the balloon. The only other thing here that I'm seeing that might be relevant, but it actually isn't, at least for this example, is the amortization period. How over which amount of time the loan is amortized. Um, is there anything else?
If you're good at this and you have a what is it called? A closing, I don't know what they're called, a closing person. Uh, I hear that you can get these done in under 30 days. You can get them done in as little as like 7 days. So time to close could be another advantage.
Okay. Okay. I think that we have a good list here. And
You're
so
also
yeah,
vetting
go
the
ahead.
you're also vetting the buyer and make sure that they're qualified.
Vet the buyer. Yes, I'm actually going to move that one over outside because we'll talk about what that looks like in practice. Let me see if I can make my
You
screen a little
mean
bit bigger
you
here.
mean betting the buyer or betting the lessee? Because we're the buyer.
So what David is referring to is the lease option buyer. And you're right, Ken, that we're talking right now about the offer we're making the seller. But this will be important when we talk about the lease option exit.
Well, it also takes the pressure off the seller of not knowing how to tell if they've got a good buyer. That was kind of what I meant.
That's right. Yeah. Yeah. So before we get further into this, I want to point out that there's a distinction that I'm making that not all investors make. And the distinction is that I'm focusing on lease options for the exit. However, there are a lot of investors that will actually lease option the house itself from the seller. And so there are reasons you might do this is, let's say it would otherwise have to be like a subject to deal. And the seller is really, really worried about the due on sale clause. There's no way to overcome that objection with them. And so if you do a lease option, the house stays in their name. There's no deed that gets transferred, and so you can lease option it from them and then do a lease option to another tenant buyer. That's called a sandwich lease option. So you're in the middle. You've got a lease option with the initial seller, and then you're lease optioning it to a tenant buyer. We're not talking about that today. What we're talking about is lease optioning to the tenant buyer once you have the house from however you want to acquire it. But we're assuming that we'll do a seller finance deal. So, all right, let's actually start putting some numbers in here. And I think for the interest rates, we probably will keep, but we'll see how that goes. So let's start with, actually, one thing that we don't have here is the purchase price, right? So how much are we actually purchasing the property for? So let's start with the purchase price. Someone throw out a number that's, real and reasonable for your market.
250.
250. Very good. Okay. All right. Now, there's kind of differences in philosophy about how you might do this, the down payment and the monthly payments. A lot of investors, people like Pace Morby, will not present a down payment or a monthly payment to the seller. They will ask the seller what down payment and monthly payment they need. I'm not nearly as slick of a salesman as Pace Morby, so I tend to make offers directly, which may not, I'm probably losing money by not having them come up with the numbers first. But anyways, let's talk about, maybe we'll start with the down payment and then we'll talk about the monthly payment. So someone throw out a down payment that's reasonable for a $250,000 house.
10%, 25,000.
25,000. Okay, so that's 10%, right? Okay. 10%. Okay. All right. And monthly payment on that, technically, if we wanted to know what that ought to be, we would run this through a mortgage calculator and get a sense of that. But someone throw out a monthly payment that would be appropriate. If not, we can run through a mortgage calculator, but I'm just trying to put some numbers in here.
Oh my God.
Yeah, you know what? This is actually an unreasonable thing for me to be asking. We really need to run this through a mortgage calculator. So in order to do that, really what we need is an interest rate. So an interest rate that we would be offering to the seller. Does anybody have any suggestions?
You could do 3.
3%? Okay.
Yeah.
So 3%. Yep.
Yeah.
All right. Nice and
3
low.
for-
That's good. Yeah.
Yeah, because
Okay.
Google has a calculator, a mortgage loan calculator. I just plugged that in for 250 with a 3% interest rate. 30-year fixed, at least in my market in Illinois. It's saying 1,000, like, yeah, 1,054. It's the monthly payment. I don't know how
1,054.
accurate that is, but yeah.
It's actually, they're adding some like closing costs or something in there.
Yeah, there might be.
It's
Okay.
948. I have 948.61.
Okay.
948.61.
Yeah, we can do that.
Okay. Wow. I'm
Oh, wait.
948.61.
Am I doing the?
That seems a little low.
You know what? I have stupid variable closing costs in here. Sorry, I was using my own calculator.
Yeah, no worries.
All good.
I guess mortgagecalculator.org is down. That's kind of lame.
What? Guess
I can
everyone's
do it
using
on my. I can do it on my handy dandy TI-80
it.
whatever.
That's funny. All right, so 250,000. and
3.
then we'll do 10% down, amortized over 30 with a 3% interest rate.
948.61 or 61. Yeah.
And I'm going to zero out taxes and insurance and PMI. Those things are all
Yeah.
relevant and important, but they're going to muddy up our calculation for now. So, okay,
Right.
948.61. You got it, Ken. So,
Nice.
all right, great. And then, so what kind of balloon do we want to be offering here, if any?
5 year.
Oh,
5 years. Okay, there we go. And I'm going to answer this one, amortized over 30 years. This one actually isn't relevant, so we'll get rid of it. And I'll move time to close over in the stuff to talk about later. All right. So is everyone with me at this point that this is an offer that you might make to a seller?
Yes.
oh wait,
Okay.
just a quick question. Is
Sure,
the
go ahead.
30-year amortization like basically saying that the monthly payment is based on a 30-year amortization, but you're paying it in full in 5 years, right?
That is correct, right? So you
Okay.
amortize it over 30 years, but you offer a balloon at 5.
Okay.
Uh,
Okay.
that's right. Okay, so this is our deal with the seller. Now let's start talking about a lease option exit. And one oversimplified way to think about this is sort of as though the tenant buyer, which is the person that's the vernacular we use when we're referring to the people who are buying these houses from us with a lease option. And we'll talk more about what that means. But one easy way to think about this is that they're seller financing the house from you. And what we're trying to do is create a realistic amount of arbitrage between what we're buying the house for and what we're selling the house for. And that's where we'll make our money. Now, there's a lot to be said about that, and we'll get into some of that later. But let's go over some of the numbers. So just bear in mind, they are basically seller financing the house from us, and that's what's going on. So I'm going to bring over all of our fields, and we'll readjust these numbers accordingly. So purchase price, we have 250,000 here. Now we don't necessarily need to. Actually, yeah, we do in this case. So what's going on here is they are buying the house from us for a fixed price some point in the future. How far in the future, we haven't determined that yet. So ideally, you would want to maybe be purchasing the house for maybe 95% of what it's actually worth, and then lease purchasing it for 100. But basically, we need to add some kind of cost on top of this. And the way you can frame this to the seller is that because they're getting an interest rate from you, they're still going to make that $250,000. So let's start with a purchase price that's a little bit higher than the 250. Does anybody have any suggestions?
3% increase is $7,500.
Okay, so $7,500, that would put us at 762,500, I think. Great. All right. And then the down payment from the lease option buyer. This is how much we realistically expect we can get somebody to put down on this house.
20 maybe. Depends on their profile.
It does. Yeah. In fact, almost everything we've talked about here has a lot of it depends. In my opinion and in my experience, 10% is about the most you can swing normally if you're trying to fill the property with the tenant buyer while you're still under contract. But we can go above that a little bit if we want. Does anybody have any suggestions?
Like maybe 12 or 13. I don't know what would be worth it.
Well, what's the profile? Like who's the tenant? Is the tenant like a high risk, low credit? If so, I think we should do 20, but what's the
Aren't they kind
scenario?
of by definition a little bit higher risk because they weren't traditional financing
Yeah.
eligible?
S-
That's
So it would
right.
be in favor to put 20 or to 25, maybe.
I guess it's a balance between what's reasonable and the fact
Yeah.
that they are going to us, so they do kind of need us kind of between there, I guess. Yeah.
That's right. In general, people that have poor credit put more down and pay higher interest rates, which sucks, for them. And that's not a great situation, but that's what's normal. So we could say maybe 15%. Let me calculate what that would be. 262.5 times 0.15, 39,375. And remember, we have to kind of keep these numbers aligned with reality somewhat, because if we don't have a reasonably good deal for a tenant buyer, then we're going to have a really hard time actually moving it, getting somebody in there before our first monthly payment is due, which is the ideal situation, right? If we get somebody in there before our first monthly payment is due, before our down payment's due, how much money do we have to actually put into the deal? Nothing. We might
Zero.
even make money, right? So, okay.
Yeah.
Do you find, Noah, though, that there's enough of a market of people who are their savings, they have a lot of savings, but they have poor credit?
Yes. So this is one of those things that at face value is unintuitive. You until you actually try to do this strategy and you realize just the sheer amazing quantity of people who fit this profile, you'll be like, no way someone's going to do this. But we can talk more about what the marketing strategy for finding these people looks like. But I mean, I probably shouldn't be doing this, but let me show you guys something. This is our Zillow activity at the lease purchase division at the company I work for in my day job. So we have, I don't know, probably at any given time, 30 or 40 listings up. This is a folder dedicated to new leads coming from Zillow and TurboTenant. There are 18,683 messages ever since this folder was created. And this one came in about an hour and a half ago. 1392 Langholm Drive. This is a lease purchase. And George Westbrook says, I'd like to schedule a tour. You get completely bombarded. Just look at these timestamps for some of these messages that we're getting.
Yeah.
We've gotten probably about 40 or 50 today. It's tremendous how many of these listing requests you get. So yes, the answer is yes. There's going to be a lot of people who fit the profile. We'll talk more about them in detail, but
Yeah, because it may not be bad credit, it may be no credit or the wrong kind of credit. Self-employed people, immigrant,
exactly.
TIN people, people who just moved back, or they just doesn't necessarily mean they have quote bad credit. They just may have non-traditional situations.
That's right. Yeah, exactly. And just to show you guys what the listing description is here. So we have this in the for rent section on Zillow. It's not technically like a regular rental. And so what we say is stop paying rent now. Welcome to home ownership, blah, 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 telling them a little bit about the program. We're telling them this is a rent to own, and the basic details, the purchase price on the house, the monthly payment. You can move in with as little as 5% down. Now that's because we're working with a hedge fund, and we can let people in for less than 10% down. But when you're just getting started, you definitely don't want to come out of pocket if you don't have to. But anyways, this is what our rental description looks like. I'm going to copy and paste this in to the chat so you guys can read it if you'd like. Oh, it's too long for Zoom. Okay. Well, I'll come back to that later. Anyways, back to our numbers here. Let's go ahead and figure out what our monthly payment needs to be. So for the tenant buyer, they're putting in they're buying it for 262,500. They're giving 15% down. We got to talk about their interest rate. So what interest rate is appropriate for somebody with poor credit buying a house? Does anybody know?
Maybe 8.5. The current rate is 7.
Yeah, I was gonna say the current rate is 7, right?
That's the current market
like
rate for people
6.5.
with good credit.
Oh my God.
Yeah.
Okay, what, like 10 for them?
I would say
No,
between 8 and 10% you can
that's
swing.
crazy.
That's crazy.
Yeah.
Yeah.
This is
Wow.
a crazy strategy.
Yeah.
Let's be conservative. We'll say 8%, right? That's basic. Like you could walk into a bank and if you had good credit, you could probably get terms that look like this.
Wow.
Okay, and they have a balloon for them. It's not strictly a balloon, but this is more appropriately said to be their lease term. So
Yeah, okay, yeah.
yeah, how long should their lease be? We have 5 years with the seller. How long should their lease be?
5 years. Wait, no, I don't know. What's the no? What's the normal?
If you can get them in pre-close, right? Then you want to make it just a little short.
Yeah, you definitely don't want it as long as your
Okay.
balloon term because if they're in there from the entire time before you have a balloon with your seller, uh, you might not be able to get them out in time to sell the house if you need
True.
to, or something like that. So I'm just going to give this one to you guys. We could say 2 or 3. Um, the longer, the better for them. Uh, so this, like anything, is a negotiation, but we'll say 3 years. All right. So now that we have this, we can figure what our monthly payment for them is going to be. And you notice market rents have not touched this equation at any point.
Mm.
This is unrelated to the market rent. Now, my rule of thumb is that if the market rent for whatever reason is higher than what this number is about to be, I go with market rent. But in most markets, it's not. Unless you're buying like houses that are like sub 200K, odds are this calculation will produce a higher number than market rent. Okay, so we're at an 8% interest rate. Let's calculate. And our monthly payment is 1637.21. So that is the monthly payment from them. Now, we are completely ignoring taxes, insurance, all the other stuff that actually matters. And just recognize that before we do this next part of this exercise. Okay, so just to review, this is our acquisition side, and this is the seller finance terms, basically, that we'll be getting from the tenant buyer. Is anybody lost or confused at this point?
No, not lost or confused. I was gonna say earlier, I didn't want to jump ahead or anything though. I think I remember you saying that for this specific strategy, you usually try to come in with the offer to the seller lower, like lower than 10%, so you have that spread for the lease option tenant. Is that
Yes.
correct? Yeah.
Yeah, so
Okay.
what the game we're playing here is an arbitrage game where
Right.
we need to be able to make offers that are sufficiently high that most sellers will say yes to us. Or at least we can play the numbers game long enough that the average seller would at least consider what we're offering. But and then selling it to a tenant buyer for numbers that are low enough that we can potentially find somebody within our inspection period before we actually close on the house. And so you can't create too much of a gap. If you're in a colder market, you could probably buy the house for like up to 10% off its market value. And because of your interest rate, the seller's still going to effectively make their asking price. And so if you phrase that correctly, then even though the contract says, in this case, 240, they're in practice over a 5-year period before that balloon hits, they're going to be making more like 275 or more. And so if you phrase that well, then you can swing a lower contract value. Um, so okay. Any
Okay.
any other comments or questions before we get into how these numbers interact with each other?
Yeah, so Nigel, that's Ram here. Obviously, this is my first time here. Sounds very interesting what I'm hearing. So on the tenant buyer side, the amount 1600, what you calculated,
That's
obviously
right.
there is certain amount which is principal, right, and the remaining is interest. After 3 years, what happens? Like, is it the tenant expected to, when you write a contract for the tenant buyer, is that a conditional purchase agreement? Is that what the tenant is going to do there, or is it still an optional thing for them to say walk out of the contract?
Yes, so they can walk out really at any point. In fact, them leaving is the best case scenario for us. Um, but to your initial comment, this monthly payment, this is actually something of an open debate within the creative finance space as to whether or not this monthly payment should be applied towards principal, or just considered a rent. The problem with that is legal in nature. There's actually a couple of things here that are legal that we need to talk about, but whether or not you consider their monthly payment principal, it should only be considered principal once they're ready to buy it, but not before. Before they are getting ready to close with you to buy the house from you because they went and fixed their credit and got a bank loan. It uh, is not actual principal pay down. And I did an office hours on the Thursday of the second week, if you want to listen to that recording, where I go over the contracts that we use with the lease option buyer. And it plainly states exactly what I just said here. It's also important to note that the down payment isn't a real down payment. This is what we call a non-refundable option fee. The reason it's not a real down payment is because it gives them a legal interest in the property. And at this point, they are not the owner. There's no pretense that they're the owner. They are a renter with a lease that has given you a non-refundable amount of money to secure their option to buy the house from you in the future for a fixed price. And it functions like a down payment, but it is importantly not a down payment. The other legal thing to be aware of here is that this lease term is for 3 years. The way your contract should phrase this isn't that you have a 3-year lease. It's that you have 1-year leases that automatically renew. And the reason for that is that if a judge how long is a lease normally in most places? It's 6 months to 12, right? And if you get into a legal fight with the tenant, you need to be able to show that you didn't have a 3-year lease. We had 1-year leases that renewed. I don't know why that's the case. Someone smarter than me figured that out, and I heard it from them. But anyways, any other questions before I move on from here?
So the down payment is non-refundable. That's what you're saying.
That is correct. So if they leave the property after 1 year, 2 year, 3 years, they forfeit that money. It's yours, and they can't get it back.
Wait, I got a question, Noah. Just real quick. So monthly payments $948.61. Are you telling the buyer to pay 900 on the right, the lease option exit? Are you telling the buyer to put 950 plus an additional 1.6K?
Yeah, sorry. This was my mistake. I didn't paste in the monthly payment that the tenant buyer pays.
Okay. I was like, it's not realistic.
Yeah. Yeah, good catch. Yeah, that's their monthly payment. And they're paying this to you. So up here at the top, I put these into boxes. And so this is your deal with the seller. It goes to the seller to you. And then this is your deal with the tenant buyer. It goes from you to the tenant buyer. There's no connection between these two directly. And I want to point that out. Your deal with the seller is independent of your deal with the buyer. Now, you still need to make sure that there's money on the table for you. But there's a good chance that your tenant buyer and your seller will never ever talk to each other directly. And if they do, it's not really a big deal. We're not putting anything in the dark here, trying to obscure what we're doing, but there's just no reason for them to interact with each other. Okay, anything else here?
No, just a heads up, you got the monthly payments in there twice now on the right side.
Do I? Oh my gosh. Okay.
You're good, bro.
There we go. All right. Okay, so let's now talk about how you make money. Hopefully the eagle-eyed among you will already start to see what's going on here, but we are buying the house for a lower terms in general than what we're selling it for. So let's talk about how much you would actually make. The way that some other smart coaches that I've seen talk about this is to divide things out into what are called profit centers. I think that's a good model for this. So we'll talk about our profit centers here, and we'll say profit centers. Let me make this a little bit bigger. Where is my font size? There we go. Okay. So shout it out if you know one of these profit centers, places where we make money as the investor.
Down payment.
Monthly, any others?
Monthly cash flow.
Monthly cash flow.
And the loan payment arbitrage.
Loan payment. I think that would be included in the cash flow, unless I'm misunderstanding something.
Well, you get equity.
I see.
Once they close out, you're selling it for a higher price. Plus, they haven't paid down the balance, and you've paid down the balance a little bit to the seller, right?
That's right. Okay. Yeah. So I'm going to call that equity arbitrage, the difference in purchase prices between the two. that looks about right to me. And we could talk about like tax benefits and stuff like that, but we're not going to. So let's talk about the difference in the down payment. This is basic arithmetic. But basically what we're doing is we're subtracting the down payment we're giving to the seller, or I'm sorry, we're taking the down payment we're getting from the tenant buyer and then subtracting the down payment we're giving to the tenant buyer or to the seller. And so in this case, we have 20 or oh man, we have 39,375 minus 25,000. So $14,000. Can anyone tell me when we make that $14,000? When in the timeline of the deal do we make that?
Up front when the tenant buyer signs and moves in.
Exactly. So this is money that we're making from the jump. We aren't waiting for this. This is the money we get right now. So when I encourage people to not do wholesale deals, this is one of the things I'm thinking about. This is so much better. It's your wholesale fee, but you're the owner of the house. You stand a chance to actually keep this house in your portfolio in the long term. So you make that money up front. Now, yeah, okay, whatever. We'll move on. Monthly cash flow. Can anyone tell me how we should figure that?
Just subtract the difference between what you're receiving from the tenant buyer and what you're paying the seller.
1637.21 minus 948.61. $688 a month. That's a pretty nice deal. All right. And then the arbitrage and the equity. And so this isn't, we're not going to be able to really calculate this in the scope of this call today, but we can sort of do it. This isn't going to be accurate, but it's more or less the difference in the purchase price. That's complicated, but it's more or less like that. So we'll take 262.5 minus 250,000, right? That's the difference between the purchase price that we're getting from the seller and the purchase price that the tenant buyer is paying. Again, this is loosey-goosey because if we actually want to know what this number is going to be, we have to figure out what the timeline is. In this case, we're assuming a 3-year timeline, and then actually calculate the principal pay down on both sides. And then those would be the numbers that we should be comparing. But we're not going to do that right now. So $12,500. All right. So let's see. And because we're looking at a 3-year timeline here, let's actually multiply this by 3 years. So that's 12 times 3. And we'll see how much cash flow we'll make in the 3-year period. So that's going to be 688.6 times 12. I've done something wrong. No, I haven't. Times 3. $24,789. Come on. Make this a little bit wider. All right. And the grand total on a 3-year deal. Let's see how much money we'll make in 3 years. And by the way, this is the worst scenario. This is the worst thing. This is the worst way this whole thing can shake out. 14,375 plus 24,789.6 plus 12,500. We are making $51,664.06 over 3 years. We don't have any of our own money in the deal. We're the legal owners of this house. Anything else?
You're going to make about another $400 a month in equity pay down off the purchase price that you make into the seller as well.
Yeah, I would suspect. Yeah, that's probably true.
That's almost another $5,000 a year.
Yeah. Okay. Well, so this is in short the financial side. Obviously, it's more complicated in important ways, but this is what a 3-year situation looks like, and this is the worst possible situation. What I mean by that is, in practice, maybe about 1/4 of the time, it'll actually work out this way, where you find a tenant buyer, they fix their credit, they go get a bank loan, they cash you out, you cash out the seller. And this is why it's the worst situation. You lose control of the house, right? The money, the house gets transferred to the tenant buyer because they're buying it from you. And you lose your control of the deal. And that's the price that you pay to earn a down payment up front and to not have to base your rent on what the market situation is. And in my opinion, I'll take that deal all day long because I have made infinite cash on cash return, infinite cash flow, right? I have my cash. I don't have any of my own money in the deal. So I'll do this all day long because I stand to lose basically nothing. But this is the worst possible situation. Can anyone try to tell me what some better possible and likely situations are?
They don't buy the house.
They don't buy the house.
Sell it again.
Exactly. Any others?
Are they asked to extend?
They asked to extend. Okay. Yeah.
Cash flow.
Is that something that normally happens? Or
it can. I guess, yeah. It's usually helpful, at least from a strategic point of view, to offer that. However, them extending it for you will be functionally the same as they don't buy it and you find another tenant buyer, except it's easier. So the way that works is after 3 years comes, they're like, oh, I can't buy it right now. I need another 2 years. You say, okay, I'll give you another 2 years, but you'll have to put down another down payment, and we're going to adjust your rent based on how much the market value of the house is now. So it's functionally the same, minus the difficulty of moving out the old tenant and moving in a new one. But from a financial point of view, it's very similar.
And is the down payment usually like the same, I guess, like full amount? Like it's essentially just starting over? Wow. Okay.
Yeah. I mean, well, you don't have to do it that way. And I just be aware that every part of this can be a little bit loose. And that's one way in which some investors might want to do things looser. It would be the path of least resistance to say, all right, I'll give you a discounted down payment, or you don't even have to give me a down payment, but recognize that you would be leaving money on the table by doing that. Now, if you do that, you have to be careful. We said that the lease term here is for 3 years, and really that's 1 year auto renewing. But if you can't give them another 3-year lease because you've got the balloon coming up with your seller. And so you need to be aware that you should really give yourself at least 6 months before that balloon's due to maneuver, right? To refinance or sell the house or however else you're going to deal with that situation.